Good morning, everybody. Mike Tedeschi over at Perspective Wealth Planning. In this week's video, we're going to take a look at the four major U.S. indexes. We're going to talk a lot about the volatility that we've had lately. We'll take a look at our breadth readings, our smart money, dumb money confidence indicator, and we're also going to take a look at the VIX itself, as volatility certainly is up. So let's jump right into it here. First and foremost, let's talk about something we haven't really mentioned too much in these videos, and that's ATR, which stands for Average True Range. Now, the Average True Range is basically taking the last 14 days worth of trading and figuring out what the average size of the daily move is, or whatever time frame you're taking a look at. When we go back before all this selling started, the S&P index was not making very big moves, right? On average, I believe the ATR was underneath 20 points. So for the majority of the days, we just had a slow, steady, small grind higher every single day. Well, if you look up here in the top left portion of the screen, we can see that the average true range now is 85 points. It is almost 3%. The S&P 500 went through a grind higher, but a very non-volatile time. The daily ranges were very small to all of a sudden we're now looking at 3% average moves. We have seen intraday 7% moves from low of the day to high of the day here this week. This market certainly is extremely volatile at this time period. In fact, when I'm putting this video together here Thursday morning, the S&P 500 once again is down over 2% overnight and is actually sitting about right here at 3050. So when we get into a period of heightened volatility, we have large moves in both directions, and that's what we've seen here this week. We've seen markets up 5%, followed by down 5%. All right. We are looking for, and as time goes on, volatility to decrease. Typically, after you see such large moves like this, we're going to see a period where it gets a bit calmer. It takes a while for volatility to die off. But if you guys remember going back to the beginning of 2018, we had that very sharp sell-off. Those candles were also very large, but you notice after a week or so of those extremely large moves, the average size moves decreased. Now, we still saw much larger moves than before the sell-off had started, but ATR, the average true range, should decrease as we move forward in time. Volatility should cut off. And in fact, let's talk about volatility now. Let's look at the actual VIX. The VIX takes a look. It's a complex formula, but basically it's taking a look at the put to call ratio on S&P futures, right? And as more puts than calls are bought, it's known as the fear indicator because people are buying puts typically to protect themselves, protect their portfolios. So as the VIX spikes, as people buy more puts than calls, it can show basically how much fear is subsequently in the market. And when we look at the VIX, I'll back this out to a monthly chart. The VIX typically is staying somewhere in that 10 to 20 range, and then we will get these big spikes, and these big spikes are fear events, so to speak. So you can see this very large candle right here where the VIX spiked up to 50. That was in January of 2018. We do not see, when we look at the VIX itself, we do not see very many spikes above 50 ever. Right? We've seen a couple in the last 20 years, and of course that was in the 2008 financial collapse, and then we did see that spike back in September of 2015 very briefly. Now, you'll notice all of these, even 2008, even though we went very, very high, we didn't stay there for more than a couple of months before we ultimately came back down and volatility kind of disappeared for a short period of time. Right, we got a spike back up to 50 last week. That is a very, very large spike in the VIX to go from that 10 to 50 in the course of 2 months. So fear was very high. Now, when we talk about sentiment, this is another way of looking at fear in the market. Now, we talk a lot about that smart money, dumb money confidence indicator when we're talking about sentiment there as well, and we mentioned numerous times that we had gotten way stretched, right? And then we had to come back down towards that middle. Well, we've done that here now, and in fact, it's going the opposite direction, where the smart money is starting to get extremely confident, and the dumb money is starting to get extremely scared, right? So we're getting to the opposite extreme that we had on the upside a few weeks ago. This is what we're going to continue to watch for, right? As the retail traders essentially become more and more fearful and the institutional money gets more and more confident, we should start to see a turning point back to the upside. All right, so the couple of things that we're going to continue to watch, we're going to watch where this VIX is, we're going to watch where this dumb money, smart money confidence indicator is. And when we have a market like we've had where we sell off 15% in a week, all right, like we saw here, you're going to get sharp snapback rallies. Now the question, of course, becomes, are we going to put in another V-shaped bottom like we did in the beginning of January of 2018, where right off the bottom back up, we almost made it all the way back to new all-time highs within a couple of weeks. Right, we bounced 10% off that bottom, and ultimately we did take the rest of the year, but we did make new highs. Right, we go back to 2018 when we had that extreme sell-off at the end of the year. All right. And here's that V-shaped rally right back up. So the market, within inside of 2 months, undid all of that selling. All right, so the question everybody is looking at right here is, was this a one-off event? Or are we going to get our major bounce back up? Well, there's a couple of things that I want to take a look at from a zone of resistance standpoint. Now, what I've just put up here is a Fib retracement. So what we're looking at is we're looking at the percentage bounce back after this sell-off. So 50% of the move is basically right where we have stopped rising here the last couple of days. It's right about that 3,020, 3,050 zone there on the S&P. So that means that we took 2 steps down, 1 step back up. You've heard me mention that before. Market tends to work in 2-1, 2-1, 2-1. So you get a move, you retrace about half of it, and then you might get a move again to that downside again of about the same size. Right? That would be that 1-2 wave. Or this is that V bottom, and we're going to see that rocket ship back up to highs. But the two zones that I pay very, very close attention on these retraces is that 50% level and that 61.8. Right, those typically tend to be those two zones where the initial snapback tends to stop. And that 61.8 comes right back at this major resistance. This is where that support was all at the end of last year, or the beginning of this year, right at the end of last year. And that is where we stopped on the first sell-off and then ultimately broke through. And that's that 3,200 zone. That's going to be the key for me if we do not get back up right above this 3150. So those are those two levels that I'm watching. Basically, do we run up here, fail, and turn back down? Do we run up here, fail, turn back down? Now, both of these, if that were to happen, whether we fail right here or fail right here, we are obviously going to be paying very close attention to where we made that initial bottom last week. That's going to be that key there, right? If we break underneath of this 2850 zone, that totally changes the nature of this market. We back this out and we look at this in on a monthly time frame, right? That is that yellow line. That's the 20-month moving average. That's the middle of the Bollinger Bands. That's where we initially held, and that's also this major monthly support. We break underneath of that. I am looking for a move back towards that 2600. That's that next area of support. So that's what I'm paying attention to here on the S&P 500. Now the rest of the indexes look very similar. We'll briefly take a look at those, right? We take a look at the Nasdaq here, right? It found support right back near that breakout zone, and it subsequently made its bounce back up there. We take a look at the Dow Jones. The Dow Jones, and I'm going to clear all these drawings out so that we have a fresh chart, really fell deeply, right? So the Nasdaq essentially would have stopped falling at this breakout level. The Dow fell all the way back to this major zone. And underneath of that, really all we have left is the lows from 2018 before we had that big bounce. So the Dow, really, really weak. In fact, look where this bounce has come back up to, guys. It's come up into that what was resistance, which should act as support that didn't. Now it should be resistance once again. So really, on the Dow, that 27,500 level is very, very important, and we need to watch that. And on the Russell, we fell right to kind of the same thing as the Dow. We fell right to that last kind of support zone before ultimately the bottom of 2018's move, right? This chart, we've talked many times, 1620 is that major level. This bounce is super weak in comparison. It didn't even get back up to that level. That's a big concern. We've talked many times about the mid and the small caps being very important here. This action that we have subsequently seen here out of the Russell is very weak in comparison to the other indexes, and that is not a great sign for us moving forward. Now, when we talk about weak, one of the things we want to take a look at is, of course, our breadth readings. Now, we've talked many times about the Nasdaq McClellan Summation Index. Look at basically where we have fallen to. We have fallen to those support levels from last year in terms of breadth, and we have actually started to fall underneath of that zone, right? We are clearly below zero at this point with this big sell-off to the downside. In fact, one could look at this as a potential head and shoulders if you're going to analyze this technically like that. This is a really bad area for us to be in terms of breadth. If we do not kind of hold on to this zone, this thing really opens up to the downside and things could get very ugly. But obviously, when you have a massive sell-off like you have had here over the last week or so, you're going to expect breadth to not be good. But here we are really at a very important key level. I really would watch that negative 350 zone on the Nasdaq McClellan Summation Index, much below that, and that really does kind of open things up to the downside. Now, the last piece that we haven't talked about so far in today's video is what the Fed did this week. They made an emergency 0.5 basis point rate cut. Now, the market had already priced in multiple rate cuts for this year once the sell-off from coronavirus essentially started a couple of weeks back. The odds that we were going to get a rate cut were high, but the market really kind of expected the Fed to wait until March meeting to make that cut. The fact that they came out on Tuesday with an emergency cut actually spooked the markets more than it helped. Initially, the move was up, and then everybody kind of went at the same time. Wow, if the Fed's stepping in this early when their meeting is coming up here soon in March, things must be really bad. And subsequently, the market essentially sold off after that. Sentiment Trader put together some great data for us on the S&P 500 returns after an emergency Fed rate cut. Now, there's only been 8 times where it's happened before. And what I want to note is over the next month, minus the financial crisis in 2008 here, the market was very positive. Essentially, the way that we can think about this is in the short term, the market said, wow, the Fed's got our back. We're going to go ahead and continue to head higher here, except obviously in the midst of a major crisis. However, after about a month, things really started to flip more in the bear side. And when we get out to 6 months and a year later, these numbers are abysmal on the long side. Average on the 6-month time period, negative 8% return, and 1 year later, negative 11.5% return. Only positive 25% of the time on both 6 months and a year later, right? And why might that be? Well, if the Fed is jumping in to do an emergency rate cut, they're really concerned about economic well-being. The market can shake things off for so long, but if news continues to stay bad, right? If in this particular instance, the virus continues to spread, international travel, international trade continue to slow down, how much money does the Fed printing help get us out of this mess? That's going to be the question that the market is going to be asking here over the next year. And if things continue to stay bad, we may see, a similar setup to what these numbers have given us in the past, and that's a couple of weeks, a month, maybe 2 months later, the market is kind of shrugging these things off. But as more and more bad news essentially continues to flow in, it might be very hard to keep this market up. So again, this is 8 data points, so that's not a huge sample size. So please do keep that in mind. I just thought it was very interesting that we did take a look at this, because 6 months and a year later, it was so drastically negative for the overall market historically. So we're going to continue to pay very close attention to what is going on here. I hope you guys have yourself a fantastic week. As always, if you guys have any questions, you can reach out to me at mtedeschi@perspectivewealthplanning.com. You can give us a call at the office at 814-580-9881. We'd be more than happy to discuss anything market related with you guys. I hope you have yourself a fantastic week. As always, I'll see you guys next week. Take care.